Hello, everyone, and thanks so much for joining us for another great webinar from the Wealth Building CPA. I'm your host, Yasmin Razak, and it is my pleasure today to chat to James Liechty of Equalys Tax Services about cost segregation and how this can help you save a ton of money on your taxes. So thanks for joining us today, James.
Thank you, Yasmin. It's my pleasure, and thank you for inviting me to be on.
Yes, Barry has definitely wanted me to interview you for a while, so I'm so glad we were able to do this. So before I go into your bio and the presentation, I just want to talk a little bit about Barry Okoye and her services for those of you who are looking to focus on building wealth, which I hope is all of you. So Barry Okoye is a CPA. She's also an active real estate investor, and of course she's the founder of the Wealth Building CPA. She owns real estate investments in 5 states across the Eastern Coast. Her company has helped over 5,000 people, just like you, preparing their taxes online and offline. She loves to help her clients, her friends, and associates to become free of financial stress. And who doesn't want that these days? She's also very familiar with money-saving strategies. And she, with her 25 years of experience as a tax strategist and her many years' experience as a real estate investor, she and her team want to make your financial life more profitable. So that was a long-winded way of basically saying if you want to save money, if you want to build wealth, if you're tired of living paycheck to paycheck, book a free consultation with a Barry on the number that you see on the screen, and start your journey to wealth. Now, over to our guest, James. So, James sent over his bio, and it was very interesting to read because I get a lot of bios sent to me. A lot of Barry's clients and guests send me bios, and sometimes they kind of meander and stuff like that, but James gets straight to the point and tells you exactly why he is a great person to work with, which I love to see. So he founded Equalys Tax Services in 2016 to help taxpayers solve challenges related to cost segregation, depreciation calculations, accounting methods, and other tax accounting issues using a practical, client-centered approach. He is also a CPA with over 18 years of experience consulting with large and small companies on fixed asset matters and tax accounting methods. Before he started the business, he spent 15 years with a large public accounting firm supporting tax practitioners across the country and solving complex problems for large taxpayers. He brings the same service to taxpayers of all sizes. James likes to roll up his sleeves and dig into the numbers. He collaborates with clients and he provides thorough documentation to support practical, taxpayer-favorable solutions. He also holds 2 master's degrees from Brigham Young University, one in accountancy with a taxation emphasis and one in statistics. He also earned an undergraduate degree in accounting from the University of Utah. He is a special consultant to Bloomberg Tax on matters related to cost segregation and accounting methods. And you can learn more about Equalys at his website, which is on the screen. So we can all agree that James is super-duper qualified to do this presentation. So thanks so much for providing that bio, James, and you can take it away from here.
Great. Hey, thank you, Yasmin, and thanks for the great introduction. And it's always good to hear about Barry and how she can help everyone build wealth. So cost segregation. Let me start off with talking a little bit about when it makes sense and when it doesn't make sense. Generally, cost segregation makes sense when a taxpayer owns property, and that typically uses about a 5-year hold period. If you're going to flip property in less than a year, less than a 5-year period, usually the cost of doing a cost segregation study does not justify doing the study. So you own property, and then the other critical factor or criteria is that you can use additional tax depreciation. You can use additional deductions in your business. Sometimes a lot of real estate investors, they have a day job, they're doing real estate on the side, and so real estate becomes a passive activity for them for tax purposes, which may limit losses. So that situation, it maybe doesn't make as much sense. If you're a real estate professional, a cost segregation study can be great. You can really offset, depending on what you're doing, you can have some significant deductions and really reduce your tax liability. And also, it's very important. I believe in looking at the big picture and what's the big picture, what situation are you in, where do all the pieces fit in. And cost segregation is just one piece of your tax return. And so I think it's very important when you're considering to do a cost segregation study to coordinate with the individual that's preparing your tax return. Because you want to make sure that the benefit of the study will flow into your tax return. If you have a business entity on that business return, and if it's a flow through up to your individual return, that it flows all the way up into your individual return and you can use the benefit. You really don't want to be in a situation where you've spent the time and money and effort to do a cost segregation study and then you don't get the deductions. So what is a cost segregation study? Effectively, what a cost segregation study, all it is taking a piece of depreciable property and front-loading depreciation deductions. So, for example, if you buy an apartment building, typically when you purchase the building, you're buying the land that the building is situated on and the building itself. And for tax purposes, the building is made up of assets that are depreciated over a 27.5-year recovery period or 39-year. That would be the things like the foundation and the walls and the roof. Other portions are depreciated over 15 years, and that's typically things like sidewalks, driveways, parking lots, landscaping, things like that. And then you may have property that's depreciated over 5 years or 7 years, and that's typically things like if there's furniture that's included in the purchase, that would be a 5-year recovery period, carpet, cabinets, specialty electric, garbage disposals, things like that. So a cost segregation study is really just going in and carving out and identifying all of those different categories of assets. And a quality cost segregation study will provide documentation that's IRS audit ready. So it's something that if an IRS exam agent comes in and says, hey, I see you've got X amount in 5-year property, you can show them the cost segregation study and they'll say, oh, okay, that makes sense. I see how you've got that allocated. And if it's a quality study, which an exam agent should be able to figure out fairly quickly, that's usually the end of the conversation. A question that sometimes comes up is what information do you need to do a cost segregation study? And pretty much that can vary anything from new construction. It's very helpful to have construction invoices and those kinds of documentation. Blueprints can be helpful. But if you have a situation where you've bought an existing building and you don't have any of that, all you have is your HUD with your settlement statement and what you paid for it, you can still do a cost segregation study on that building. You simply just go in and kind of recreate the costs, and that's a methodology that's accepted by the IRS if it's done in an appropriate manner. So the benefits of a cost segregation study, again, they accelerate depreciation deductions. You're not changing generally you're not changing the total amount of depreciation that you can take. You're just changing the timing. There may be instances sometimes when you buy a property and you allocate too much purchase price to land and too little to the building or vice versa. And in those situations, you can come in after the fact and make a correction to correct that, and that will change your total depreciation. But in general, you're not changing the depreciation. You're just saying we're going to take deductions today instead of tomorrow. So in a sense, it's a cash flow benefit you get from doing a cost segregation. It's a net present value benefit. And if you don't do a cost segregation study, effectively what you're doing is making an interest-free loan to the government. For tax purposes, you also are supposed to identify different building systems, so your HVAC system and your windows and the building envelope and things like that. A quality cost segregation is a great time to go in and identify those parts of your building, which that can impact. If you're doing roof repairs or major repairs in the future, having those systems identified can actually allow you to claim additional deductions. So when can you do a cost segregation study? They can be done in the year the property is placed in service, and that's when you get the best time value of money benefit for doing a cost segregation study. Or you can do them in a year after the asset's placed in service, which is often referred to as a look-back or a historical study. And when doing a look-back or historical study, often you get a catch-up adjustment. So in effect, what you do is you look at the depreciation you should have claimed in the past that you didn't, and you get to take that amount as a deduction on your current year tax return. That's referred to as a Section 481 adjustment or 481 adjustment. And those adjustments can be quite significant and quite beneficial. Let's just talk through an example of a cost segregation study for a minute. So assume a taxpayer purchases a building for $3 million, and they allocate an apartment building, and they allocate $1 million to land and $2 million to depreciable property. So if they don't do a cost segregation study, typically what will happen is $2 million will be depreciated over 27.5 years. And stepping back just a little bit, it's very common for practitioners that are not specialists in cost segregation to take kind of a high-level approach and just take the $2 million in this case and put it in one category. It's kind of a specialty area to go in and really document how everything's allocated out. So, you know, a lot of tax return preparers will just take this kind of shortcut approach. Typically, the IRS won't challenge it because you're not being aggressive. You're not taking too many deductions. Some practitioners will allocate things out and break them out. But back to the example. So if you do a cost segregation study, and these are a little bit of conservative estimates, I'm estimating about 69% you could put as 27.5-year property, 5% to 15-year property, 1% to 7-year property, and 25% to 5-year property. We'll talk about this in just a minute, but currently for property with a recovery period of 20 years or less, you can take 100% bonus depreciation and deduct the basis of that property in the year it's acquired. So this example assumes that is done, and you know that's a pretty significant benefit. So on the next slide, you'll see the kind of the numbers behind this example. So really, the net number I'd key into is the tax savings of the net present value, which is around $124,000 on this. So that's a significant number, a significant amount of tax savings that available to a client. And effectively, what you can do, you know, is you've got your $519,000 about that you're going to reduce your taxable income, and so that's, you know, that can be significant, especially for a taxpayer that, you know, they've got other places where they could be investing that money and get it working for them. As far as a tax depreciation update, well, before I get into the tax depreciation update, often going back to the example, the cost to do a cost segregation study really depends on the property, how large it is, how complex it is. But often, I always kind of joke that if I could get the same return on investment for a cost segregation study when I invest in the stock market, that's all I would do is invest in the stock market. Most of the projects I've done, I would say all the projects I've done, the return on investment has been in the hundreds of percents. And sometimes, depending on the project, it's been in the thousands, like a 2,000% return on your money kind of thing. Which, you know, of course, that varies by the project and the fees and everything. So you have to see what that would be for your specific project. Okay, so turning to a tax depreciation update. So there are really two topics here. I've got Section 179, which allows a taxpayer to take a deduction for certain depreciable property. And there are several limits around that, an income limit and and the amount of property that you purchase. But basically, the 179 deduction is increased to $1 million. And so that can be, if you fit the criteria to do a 179 deduction, you can get a significant benefit from that. 179 has also been expanded. Generally, 179 applied to personal properties, stuff with a 5, 7-year life, 15-year life, sometimes. But it's been expanded to include some real property, qualified improvement property, and some roofs and HVAC equipment where it's not the first HVAC that was put in at the time the building's placed in service. It's got to be put in at a subsequent time. 100% bonus depreciation. Wow, I'm not quite sure what to say about this. This is really amazing that we have this law in place, and it's in place for a 5-year period, and then it starts to phase out. But bonus depreciation, basically any property that you purchase has a recovery period of 20 years or less for tax purposes. You can immediately write off if you want to. Now, if you don't want to, you can make an election not to do that and use the regular lives, and sometimes that makes sense to do depending on your situation. But where you're looking for deductions, it usually does not make sense to do that. So bonus depreciation used to only apply to brand new property. That was for property acquired before September 27, 2017. I'm sorry, before September 28, 2017. But now it applies to both new and used property. So a couple of things to watch out for bonus depreciation. One thing to watch out for is many states do not, they decouple from bonus. They don't allow you to take the deduction for state purposes. So you may be able to take it for federal purposes, but not for state purposes. I hope this was helpful. You've learned something about cost segregation, tax depreciation, bonus depreciation, Section 179. It's kind of a quick run through on these topics. If you do have any questions or would like any assistance, feel free to reach out to me. You can reach me at the number on the screen or by sending me an email, which would also be on the screen. And I'd like to again thank Yasmin and Barry for the opportunity to do this presentation, and I look forward to hearing from you.
Thanks so much, James. That was great. I mean, it was short and sweet, which I think is just about the right amount of time for this kind of topic. Otherwise, people sort of get blinded by science. So I do appreciate you simplifying it as much as possible. And as James said, if you are interested in what he has to offer or want to learn more about it, please do have a look at the screen. You'll see all the ways to contact him, check out his website. Connect with LinkedIn. I'll connect with you on LinkedIn as well, James.
That'd be great.
So definitely don't hesitate. You're serious about your wealth building if you're on this, if you're watching this webinar. So, now's the time to take action. So thank you so much again for doing this, James, and thank you, everybody.
You bet. My pleasure. Thank you, Yasmin, and have a good evening, everyone.
Okay. Thank you.
Thanks.